If you were waiting for Jensen Huang to finally post on X, you probably expected a sleek render of a new GPU architecture.
Or a leather jacket restock announcement.
Laughs. Right. Instead, on this Friday, July 24th, his very first post was about policy. He shared a sweeping open-weight AI letter. It makes you step back and ask, why now? Welcome to the Working Thesis. I am Maya.
And I am Theo. Today, we are looking at the changing geometry of the AI industry. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let us get this central theme on the table right away. Friday gave us a harsh semiconductor sell-off and a major open-weight policy campaign. These are separate stories, but they rhyme around one question.
Exactly. They both ask the same question. Who gets to earn the return on AI? The market is scrutinizing the hardware chain over the cash required to build the future, while a coalition spanning chips, cloud, platforms, and applications is lobbying to keep the model ecosystem open.
It is a tug-of-war over margins.
The broader market stabilized. The Dow rose 0.46% to 51,947, and the S&P 500 added just 0.05% to 7,411.
But the Nasdaq lost 0.64% to 24,975, while the VIX eased slightly to 18.58.
The real story was underneath. Crowded hardware sold off while parts of software held up.
Korea-led memory deleveraging set the tone across Asia. The Nikkei dropped 2.73% and Shanghai fell 1.61%, while Europe's DAX rose 1.36%.
The weakness cascaded globally. SanDisk fell 10.79%. Micron and Western Digital lost roughly 7%. Seagate dropped 6.75%.
It bled right into wafer fab equipment and optics. Applied Materials and Lam Research both lost roughly 4.6%. Marvell dropped 7.21% and Coherent sank 9.84%.
You have to look at the ETFs to see the real rotation. The SOXX Semiconductor Index fell 4.4%, and the SMH dropped 3.27%. It was a heavy exit from silicon.
But this was not a broad abandonment of growth. The IGV software ETF actually rose 1.01%.
At the ETF level, capital did not flee technology. It moved up the stack. Friday favored software over silicon.
That brings us to Intel. The headline quarter was genuinely strong.
They did. Official Q2 revenue was $16.13 billion, up 25% year over year. Non-GAAP EPS came in at 42 cents. And non-GAAP gross margin was 41.8%.
The third quarter guide was also solid. $15.8 to $16.8 billion in revenue, non-GAAP EPS of 38 cents, and a non-GAAP gross margin of 42%.
And yet, Intel closed at $92.32, down 7.89%, after initially spiking near $115 in after-hours trading. Why? Because capex and cash return timing became the test.
Right. Intel reported Q2 operating cash flow of $7.0 billion, but its own adjusted free cash flow reconciliation came to negative $8.419 billion. Intel also raised 2026 capex to more than $20 billion and said 2027 spending would be significantly higher.
It is a massive structural build-out. Benzinga reported Kramer calling Intel the one. Friday's tape answered, "It's not you. It's your capex."
Laughs. A painful timing joke, but it highlights the market's strict demands for cash flow today versus infrastructure tomorrow.
Today's other AI story was about control of the model layer. Jensen Huang shared a letter titled Open Weights and American AI Leadership.
It is backed by a 25-company coalition. Signers include NVIDIA, Microsoft, Meta, IBM, Dell, Palantir, Hugging Face, Mistral, and more.
Satya Nadella shared it too. The core argument is that open weights widen access, foster competition, give customers control, and strengthen national technological sovereignty and cybersecurity defense.
The letter does not ignore the risks. It openly admits that once weights are released, control is difficult to recover, and tracking modified versions is hard.
But they are asking policymakers to avoid premature sweeping restrictions. They want broader access to compute and shared training assets. and they want Washington to address unlawful extraction through targeted legal frameworks rather than suppressing legitimate distillation.
It is a calculated plea. Police the bad actors, but do not shut down the open ecosystem.
We should clarify what open weights actually means because it is not necessarily fully open source AI. A downloadable weight file does not guarantee you see the training data, the training code, or get a highly permissive license.
Think of a neighborhood restaurant. A closed API keeps the recipe and charges for every plate. Downloading the weights is more like receiving the recipe.
And then discovering the recipe was the easy part. You still need a commercial kitchen, industrial stoves, fuel, ingredients, refrigeration, and skilled cooks to serve thousands of meals without poisoning anybody.
The recipe gives you control and freedom to change the dish. It does not make the kitchen free. Downloadable weights do not make a 2.8 trillion parameter model cheap, easy, or automatically safe.
Speaking of massive models, let us look at Moonshot's Kimi K3, launched July 16th. This is a 2.8 trillion parameter model with a 1 million token context window and native vision.
It uses a sparse mixture of experts, activating just 16 of its 896 experts. Moonshot recommends supernode configurations with 64 or more accelerators just to deploy it, which perfectly illustrates your kitchen analogy.
Moonshot says overall performance still trails Claude Fable 5 and GPT 5.6 Sol, despite strong coding and agentic results. The real verification point is Monday, July 27th, when it promises the weights and technical report. Hosted access is live. The package and license remain pending.
Kimi K3 sits right at the center of the distillation debate. Anthropic publicly alleges that Moonshot used more than 3.4 million exchanges across fraudulent accounts to target Claude's agentic reasoning, coding, and tool use.
We have to attribute that strictly as Anthropic's finding. But it draws a hard line between legitimate distillation, using one model's outputs to train or improve another, and alleged industrial-scale fraudulent extraction through fake accounts.
Which explains why Anthropic supports strong export controls on both advanced chips and model weights. They argue illicit distillation strips safeguards and weakens U.S. advantage. But if Kimi K3 still trails the very top proprietary systems overall, why would Anthropic feel much pressure yet?
Because pricing pressure does not wait for perfect parity. Anthropic's models are differentiated in coding and complex agentic workflows. Exactly the capabilities Moonshot is marketing and Anthropic says were targeted. A cheaper open alternative can narrow the premium even before it wins every benchmark.
The coalition agrees that unlawful extraction is a legitimate issue. It rejects turning that specific allegation into a ban on all distillation or all open models. That distinction will shape both competition and policy. Some commentators read this open weight push and immediately declared that the frontier labs are finished. That seems far too simplistic.
It is. The evidence supports competitive and policy pressure, especially for Anthropic, but certainly not panic. Closed frontier systems still retain meaningful advantages in top-end capability, managed reliability, enterprise support, and safety tooling.
Deployment is also far easier, and while OpenAI did not sign, Sam Altman welcomed both open weight and proprietary models. Not every closed lab is anti-open.
Ultimately, you have to follow the economic incentives. NVIDIA signed because they benefit from more inference and GPU demand.
Microsoft Azure benefits from hosting a wide variety of models. Meta's strategy benefits when base models are widely available, and distribution, applications, and developer ecosystems matter more.
And application companies benefit from model choice and price compression. These are not secret ideological motives. They are transparent business models driving policy positions.
Where does that leave the thesis? The bull case for open weights is that it widens access, invites security scrutiny, and ensures national technological sovereignty.
The bear case is irreversible proliferation. Once highly capable weights circulate freely, you cannot recover control. If actors strip away safeguards, defense becomes incredibly difficult.
It is one of the defining regulatory questions of this AI cycle, and Friday's letter, along with Jensen's post, was a major opening argument.
Looking ahead to next week, the evidence calendar is packed. On Monday, July 27th, we are watching for those Kimi K3 weights and U.S. durable goods orders.
Wednesday brings the FOMC decision, plus earnings from Microsoft and Meta.
Thursday delivers the advanced Q2 GDP, PCE data, and earnings from Amazon and Apple. We will also monitor WTI crude, which slipped to $90.47, and gold at 4-day 55.72, alongside the 10-year yield at 4.68%.
The genuine open question we take into next week is whether the model layer can keep charging rent, or if it becomes a commoditized ingredient.
Mylene is a barbell. The hardest frontier work may keep premium pricing, while routine tasks shift toward cheaper open or specialized models. More value could migrate into cloud operations, harnesses, proprietary data, and applications. But that is one lens, not the answer. The frontier keeps moving.
The evidence that will settle it includes actual weights and licenses, independent evaluations, enterprise switching, API price compression, cloud utilization, and capex to free cash flow conversion. We will track it all. Thank you for joining us on The Working Thesis.
See you next time.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.